Before you buy any oil stocks, read this. Hydrocarbons have been a pillar of economic growth for the last century, and we'd argue that the pace of globalization could not have occurred without oil and gas. Love it or hate it, oil is a lifeline to international trade. In turn, it provides incredible economic growth and investment opportunities around the world. While Katusa research is pro-decarbonization, we're not suggesting that we eliminate all oil and gas production immediately. The world is not ready for a 100% oil and gas-free world. One day, yes, but not today and not anytime soon. Oil and gas producers are under fire to change, especially the largest integrated oil and gas companies. Seemingly every week, there's a new headline about Shell, Exxon, Chevron, or one of the others facing a new scrutiny or under fire from another ESG group. This week, we're putting that to the test. So if you own oil and gas stocks, you'll want to pay close attention. We're in the first inning, and this report is just the tip of the iceberg. Back to basics. Emissions intensity for oil, gas, and refinery operations. Here's a chart that shows the amount of greenhouse gas produced per barrel of oil equivalent produced or refined. You can see the natural gas production emits the highest amount of greenhouse gas. Methane is a key reason for this. Now let's get deeper. Integrated oil company analysis. The largest emitters in the oil and gas world are the world's integrated producers. These companies extract oil and gas from reservoirs, refine it into everyday use products like gasoline and petrochemicals. Then they sell those refined products further downstream or to end users. The next chart shows the Scope 1, 2, and 3 emissions for the world's largest integrated oil producers. You'll recognize many of the names in the charts as they are some of the world's largest oil companies. I'm focusing mainly on the Scope 1 and 2 emissions because these are the most quantifiable today. But if you note, now coming up in red, the enormous Scope 3 emissions levels of Chevron, Exxon, and Shell, you see the complete emissions picture and how massive it is. Intuitively, this makes sense. These companies provide enormous amounts of oil and refined products which are combusted in gasoline, used in petrochemicals, and burned for power generation, all of which are applicable to Scope 3 emissions. So how does a net zero world affect the bottom line of these companies? Glad you asked. Let's apply our carbon tax to these Scope 1 and Scope 2 emissions. If you're going to take home anything here, take this home. You'll see the annual carbon tax liability is in the billions for most of these companies. Several of them use internal carbon prices of $25 to $50 per ton, which assists in long-term capital planning decisions. For consistency, we use the same. No question, these are big bills. To put this into perspective, let's compare this tax hit to earnings. We can use the annual carbon tax paid relative to EBITDA, earnings before interest, taxes, depreciation, and amortization, because this is easily measurable across all companies. Next is a chart which shows a $50 carbon tax liability as a percentage of forecasted 2022 EBITDA for the integrated group. With the exception of Equinor, who's been well ahead of the curve in emissions reductions, a $50 carbon tax would be a considerable hit to company earnings. Suncor is the biggest loser in the group and will be the most impacted by a carbon tax. Canada's carbon tax is already $50 per ton and going higher. This is bad news for Suncor. Key takeaways. We don't know if we'll see a global carbon price, but we should, as it would accelerate the decarbonization process, but we do believe national carbon taxes will become the norm. Due to carbon taxes, we expect many companies to revise cash flow forecasts and asset values. Be smart with allocating to countries which do not have a carbon tax yet. This may lead to unfortunate surprises for those who have not modeled in a carbon cost. We've done a deep dive on many major commodities and companies, including what their carbon liabilities will be. Many will find it difficult. Few are positioned to thrive. As an investor, if this is not on your radar, it needs to be, and quick. Cheers. Subscribers to our premium research service, Katusa's Resource Opportunities, are well aware of how big we expect the carbon sector to become, and how to steer clear of not just oil, but gold, silver, and base metal companies that will be hit with major carbon liabilities. Do yourself a favor, click on the link below, and check it out.
Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.